Especially with all the drama between China and the US, investors often worry about the threat of a company getting delisted. But what happens when a stock gets delisted? Are you going to lose all your money? Let's talk about that. Delisting is when a stock exchange, think the New York Stock Exchange, the London Stock Exchange, among others, it's when one of those exchanges removes a stock from its exchange. This means that that exchange won't let people trade that stock on their exchange. Now, why would a stock get delisted in the first place? Well, for one, there are often a lot of quantitative rules that each of the exchanges will have. For example, the NASDAQ currently requires that stocks listed on their exchange have a share price of at least $1, have at least 400 shareholders, and they have some additional shareholder value thresholds. So in order to stay in the club of being listed on an exchange, you have to meet their special rules. Now, one of the most common things that causes companies to fall under these quantitative thresholds is something like bankruptcy, where shareholders are often getting wiped out, so the stock value will drop probably close to zero, which will typically be under whatever the quantitative share price threshold is. So when that happens, oftentimes these bankrupt stocks get delisted from major exchanges. This isn't to say that they can't get relisted eventually, where they clean up their balance sheet, they go through the restructuring process, and thus they meet all the quantitative rules again, they might be able to come back onto the exchange. Besides these quantitative rules, regulatory issues might be a big issue as well that could cause delisting. And investors are definitely spending quite a bit of time focusing on this risk right now, especially when it comes to China and the US and the different risks associated with maybe the US forcing Chinese stocks to meet certain rules. If they don't, then they're forced to delist from US exchanges or vice versa. So there's always this overarching risk of political instability that could cause companies to delist. And another common way a stock might get delisted from an exchange is to go private again. They have private investors come in to buy the company out and they take it off of the public exchanges. So we know why a company might delist, but what happens when a company actually delists? Like I mentioned earlier, when a stock gets delisted, it means that it can no longer be traded on that exchange. It doesn't mean it can't be traded at all. It probably just means it'll be harder to actually trade that stock. Oftentimes, these delisted stocks can be traded not on the major exchanges, but instead through the over-the-counter markets, where there might be less stringent regulatory requirements, but you can still trade these securities back and forth. It just might be a lot less liquid than something like a major exchange. And that's really the major thing that can change with a delisting, is that the company now has less liquidity or less easy access to capital by being able to trade its stock on the open markets. When a company is traded on a major exchange, that is often a big trust factor for many investors, and that could be the difference for certain companies in raising the amount of money that they want to raise. But notice how business fundamentals aren't changed by delisting. The business still exists. It's not as though it went bankrupt, though often bankruptcy leads to delistings, but we're talking about the opposite here. Does bankruptcy automatically happen when a company gets delisted? Well, no. All that happens is the company might have a harder time raising money through the equity markets. Now, for individual shareholders, some companies have different share structures depending on where the shares are listed, and that can cause some complications, though again, it wouldn't change the underlying fundamentals of the business, but it might affect you as a shareholder from maybe a tax perspective or from a liability perspective, since you might have to transfer your shares somewhere. And there are other nuances to potentially consider as well. A lot of things could happen here. This has definitely been a concern with a lot of dual listed Chinese stocks, which might have a listing in the Hong Kong exchange, but also one of the Western markets, maybe in the US. Alibaba certainly comes to mind. And if you guys want to see a really good breakdown on what would happen if Alibaba got delisted in the US, definitely check out the video. I'll go ahead and link it above to Brad Callner's channel. He did a great breakdown showing how you'd actually get your shares transferred over to the Hong Kong exchange so you wouldn't lose those shares or anything like that. But the point is, there are probably some pretty significant nuances with each individual company if it were to get delisted. So if you're worried about that, you should do some extra due diligence. But should you really worry about delisting? And I went through a few case studies to see what actually happens to a company when it gets delisted, and I specifically looked for Chinese companies. I came across a pretty interesting study by an MIT grad student from a couple of years ago, so we'll go ahead and take a look at that. One example of a company that was delisted was Shenzhen Mindray. It was bought out by private investors, so it was delisted from the US. They then IPO'd the company in China, and after 3 years, they were able to quadruple the market value of the company. So business success is definitely still possible without the US financial markets. Another example to look at would be United Healthcare. and that it was taken private in 2014 after having been on the NASDAQ. It was at a value of about $214 million. A few years later, in 2019, it was actually taken public again in the US markets via a SPAC merger and was put on the New York Stock Exchange this time. And that was at a valuation of $523 million, so well over a double during that span. That one's kind of cheating because it's going back onto the US markets, but you still get the point. They were able to grow the business during that time without being publicly listed. And another example of a company getting delisted, this time for some very bad reasons, would be Luckin Coffee. Once a darling of the Chinese companies, it was eventually revealed that 75% of the company's reported revenue was fraudulent, so the stock value tanked. After the fraud was revealed, on one day in April of 2020, the stock tanked 80%. NASDAQ went on to delist the shares in June of 2020, and this is still a bit of an ongoing case since we don't really know where Luckin will eventually end up, but needless to say, things have not gone too well. Now, one issue with looking at case studies when it comes to delisting is it's very difficult to tell what's actually causing the drop in business value. Is it because the company is being delisted, or is it because the company revealed fraud or is going bankrupt, therefore shareholders are in big trouble anyways? But in any event, you can see that business fundamentals are ultimately what's driving the value of these companies. When the business fundamentals get better, typically the business valuation gets better. When the business fundamentals get worse, with something like fraud in the case of Luckin Coffee, things get worse. So should you be worried about a company delisting? Well, probably not for the delisting itself. Sure, it might get harder to actually sell or liquidate those shares if you're trying to do that, but if you really believe in the long-term fundamentals of a business and you're investing for the long term, then it shouldn't really move the needle that much in either direction. That said, if you were to get a complete seismic shift in the regulatory environment where, say, maybe US investors are completely disallowed from investing in Chinese companies, that no US capital can go into the Chinese markets, that probably wouldn't be a very good thing. But you could also make an argument that if you ride things for the long term, that maybe in a couple decades things would be able to relist and you'd be able to easily get your money out of the investment after the business has grown because you're such a good investor. But just because a company is publicly listed does not necessarily mean that it's going to be inherently worth more. It might be easier to raise money and that could help the business in a fundamental sense, but generally speaking, there's a lot of money swimming around in the private space as well, and companies can still raise quite a bit of money that way. But if you don't want to go through the headaches of a stock being delisted, especially by force through something like regulations, then maybe you shouldn't invest in those sorts of companies because it's just simply not worth the stress of worrying about that sort of event. But if everyone's scared of that and it doesn't actually happen, then maybe you get an opportunity to get a stock at a discount. Whatever the case, definitely do your research when it comes to investing in any sort of stock and talk to a licensed financial professional if you need advice. If you like this video, definitely like it since that would help the channel out a lot, and be sure to subscribe so you don't miss new updates since I put out new videos every single week and wouldn't want you guys to miss out. And check out the free stuff and the affiliate links in the description below. But until next time, take care.